Hey, with interest rates at historic lows, I mean, so low that we're actually seeing negative interest rates in some parts of the world, why do we think it's still a good idea? Or why would anybody still invest in bonds in a diversified portfolio? Well, in this video, I'm going to talk about why we believe it's still a good idea to continue to invest in high quality bonds in a globally diversified portfolio. How's it going, everybody? I am Dan Lohmar. I'm a certified financial planning professional with United Wealth Management, where we specialize in peer app management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bealey, and I are both pilots for United. Welcome to another video. Hey, before we get going, don't forget, remember to subscribe and hit the bell icon so that you know when new videos come out. Thank you very much. And as always, I'm going to talk about what we believe is a good idea, why we continue to invest in bonds in a globally diversified portfolio. That's what we believe. So please don't take this as tax, legal, or investment advice. So it's up to you to determine the suitability of bonds and what I'm talking about in your portfolio. Thank you. So why are we investing in bonds in such a low rate environment? Well, there are a couple reasons. The number one reason is quality, though. That provides stability in the portfolio. And we expect that stability from high quality bonds, that's for sure. We don't expect that stability in high yielding bonds and during times of financial stress. So that's the most important reason we continue to invest in high quality bonds in a globally diversified portfolio, and that is stability. Now, why is stability so important? Well, there's a number of reasons. One is a decreasing volatility of the portfolio. Okay, so this comes down to a personal risk tolerance. So some people are just not as aggressive as others. Some are just very conservative. And so if you don't want to see as much volatility in your portfolio, you might want to have 40 or 50% bond in your portfolio, and you really decrease that volatility quite a bit. Now, does that also would decrease the long-term expected returns of the portfolio? But it all comes down to your financial plan and whether that's right for you. But anyway, that's the biggest reason, is risk tolerance. And even in all of our portfolios, our most aggressive portfolio, which is 90% equities, we still have a 10% bond position in there. And that gives us, that brings us to the number two reason, which is rebalancing. So having something that is not so correlated with equities, that stands up strong during times of financial market stress, is a good reason. It gives us the opportunity to rebalance into and out of equities during those times. So let's just say we have a good run up for a year in the portfolio. We can take some money off the table in equities, and we have a place to put it in safe, high quality bonds. On the same side, like we've seen here recently in 2020, we've seen a decline in the markets. And so that gives us opportunity to take some money out of the bond position, actually buy equities when they're low. So rebalancing like that is kind of an auto way of buying low and selling high. So that's number two reason. It gives us a chance to rebalance. And number three is in retirement. This is pretty important here. Really, one of the things, primary objective of a portfolio in retirement is just making it last, as long as we can. And one of the ways we do that is we really don't want to take principal out of that portfolio, out of the equity side when equities are down. So having bonds in the portfolio in retirement, it gives us a place to take income distributions out of the portfolio, not having to take them out of equities. And when I say income distributions, part of that is yield. Yeah, part of that is the interest that the bonds are kicking off. But we are primarily talking about taking principal out of the bond position and just leaving the equities alone. So again, we're not looking for the interest from those bonds to provide that income. We're looking for principal to do that as well. So those are three big reasons that stability in a portfolio is pretty important. So why not just, like a lot of times people ask this in the stock market, if the stock market's doing so bad, why don't we just go to cash for right now, wait for things to get better? Same thing. So people ask the same thing about the bond market. With bond yields are so low, why don't we just put the money in the money market right now? Yeah, they don't have good returns either, but a little bit more stable, and then we could just go back in the bond market when interest rates go back up. Well, there's a couple things here. The bond market is just as impossible to predict as the stock market. So really, there's no good way to say, hey, that when the bond market's going to get better, or sit on the sidelines until it gets better. We still continue to believe we're missing opportunity by doing that. And so we just continue to invest in it that way. The other thing to think about too is that the bond market has several components that make up total return and not just interest rate return. So even though interest rates might be low, there are other components that make up the total return of the bond or the bond fund that we're investing in. And we're looking at credit quality and maturity. So as those things move around, so do bond prices. And so it's not just a matter of the interest and the coupon payments that the bonds are kicking off. There's a lot of things to consider as to what the total return of the bonds and the bond funds are going to be. So the next question is, well, if the yields are so low, why don't we go down the credit ladder and invest in high yielding, less credit quality bonds? High yield bonds are kind of a hybrid between safe bonds and equities, and they don't really fit either role that great, in my opinion. So they are, when you want the stability of a bond in times of financial stress, they're not there. They usually, they have a tendency to be highly correlated with the stock market during times of financial stress. And I'll show you a graph here in a minute. That's exactly what they did here recently in March of 2020. So here's a really good example just to show you that not all bonds and bond funds are the same. Here is what we saw in February, March through the end of April in 2020. So the black line is the S&P. That's actually the iShares ETF of the S&P 500. So as we saw, we really saw a really pretty steep decline. I think it was 34% from February 19th down to late March, third week in March there. And as we see, here's 4 different bond funds. So the top green line is a high quality, nothing but, it's 100% government AAA rated bonds. As you see here, it did exactly what we wanted it to. It provided that stability, and its total return during that time period was positive. So it did what we wanted it to do. That was really, that was nice to have that as part of our position. As we go down the bond quality ladder here somewhat, the blue line is the Barclays aggregate iShares Barclays aggregate ETF. And as you see here, it's more representative of the total U.S. bond market. And you see here, it did fine, but it wasn't quite stable as something that had nothing but high quality bonds in it. The pink line is the municipal bond market, and that is represented by the iShares municipal bond ETF. And then right here, this is the high yield bond fund. And as we see here, we really see it highly correlated with the S&P 500, the equity market. We saw no stability really here at all. And so it didn't provide, it didn't stand up so well. And that's typically what happens in a high yield bond fund. So the other thing to keep in mind is inflation. So real returns or real interest rates or coupon payments of bonds is one thing, but also keep in mind what that is relative to inflation. So the nominal return is one thing, but then the real return is always the return relative to inflation. So even though interest rates are low, so is inflation. So keep that in mind as well. And even because we could have a bond yielding 4%, but if inflation is 3.5%, we're kind of at the same real return. So just keep that in mind also. Inflation's been pretty tame here lately. So those are the big reasons we continue to believe and we continue to have high quality of bonds as an essential part of our portfolios. Quality, which we expect stability, risk tolerance, rebalancing, income generation, so selling principal and retirement as part of it. And we're also looking at the total return, not just the nominal or the interest rate of the bonds, and then keeping in mind what it is doing relative to inflation. That's why we continue to have those in our portfolios and why we continue to believe that investing in high quality government bonds is still a valuable part of a globally diversified portfolio. Hey, if you got any questions, comments, recommendations, referrals, shoot me an email, dan@unitedwealthmanagement.com. I'd be glad to hear from you. If you like this video, give me a thumbs up and remember to subscribe and hit the bell icon so that you know when new videos come out. Till next time, fly safe.